Hi friends, welcome back. Today we are discussing about the ratio analysis in the financial management. First of all, let us see what is a ratio. A ratio is a quantitative relationship between two amounts showing the number of times one value contains within the other. Current ratio is equal to current asset divided by current liability. And if the current ratio is 2, it means that the number of times one value contains within the other, that current liability is contains 2 times in the current asset, or current liability is half of the current asset. That is the meaning of current ratio is equal to 2. One of the definitions of ratio analysis is that it involves the comparison of financial data to gain insights into the business performance. Ratios can give better idea about the firms than the standalone figures. If we say that one firm has made a profit of 1 lakh rupees and another firm has made a profit of 10 lakh rupees, it doesn't convey much. If we compare the sales or capital employed of each firm with the profit generated by them, we will get a better idea of the operational efficiency of each firm. Ratio analysis studies the relationship between two numbers or group of numbers in a financial statement in a logical manner, which allows us to make meaningful decisions. From this, we can see that sometimes we are comparing individual figures like sales, gross profit, or net profit. Sometimes we are taking a group of numbers like current assets, current liabilities, or proprietors fund. And also, you cannot just compare any two numbers. There should be some logical relationship between these two numbers. There is no point in comparing with the salary and the fixed asset, or traveling expense and the purchase. Once we calculated this type of ratios, we can take some meaningful decision, like if the debtors collection period is too large, we have to resort to reducing the collection period. And if this is our gross profit is less, we have to try to increase the gross profit. We have innumerable number of ratios, and the ratios are classified to many types. Some of the types of ratios are: 1. Liquidity or short-term solvency; 2. Leverage or long-term solvency; 3. Activity ratios; 4. Profitability ratios; and 5. Coverage ratios. This classification is not unique because different authors are classified it in many different ways. So it is only an indication, or it is only as an example I am giving to you. So it is not important to know the classification of the ratios, but it is important to know how to calculate the ratios. We are not going to do all the ratios here one by one, but what I am going to do is to do some problems, and I will explain then and there the ratios which we needed to solve the problem. That will be an easier method, and it will be easy for you to understand. Prepare a balance sheet from the following data: stock turnover ratio on the cost of goods sold 7 times, gross profit to sales 25%, sales to fixed assets 2 times, average debt collection period 1.5 months, current ratio 2, liquid ratio 1.25, net working capital rupees 8 lakhs, reserve and surplus to capital 0.25 times, long term debts nil, all sales are on credit terms. We need to prepare a balance sheet from the given information. We have given some ratios and one figure only. There is only one absolute figure, that is net working capital of rupees 8 lakhs. In this type of problem, we need to check what are the ratios connected with the absolute figure, and we have to proceed like that. When we find out new figures, we need to check what is the other connecting ratios of this one. This is the beauty and difficulty of this problem. It is like a filling crossword. We know net working capital is equal to current asset minus current liability, that is 8 lakhs. Another ratio is also there, current asset divided by current liability, that is the current ratio, which is given as 2. From these two information, we can start. From the above two equation, we will get current assets is equal to 2 current liability, and substituting 2 current liability minus current liability is equal to 8 lakhs. So the current liability is 8 lakhs and current asset is 16 lakhs. Liquid ratio is given as 1.25. Liquid ratio is equal to quick asset divided by current liability. Quick asset means current asset minus stock. So the formula works out to be 1.25 is equal to 16 lakhs minus stock divided by 8 lakhs. Then the stock is 6 lakhs. Since we found out the stock, we can check for a ratio which is connected to the stock. We have given the stock turnover ratio is 7. Stock turnover ratio is equal to cost of goods sold divided by average stock. So 7 is equal to cost of goods sold divided by 6 lakhs. Here the opening stock is not given, so we will take the closing stock as the average stock. We will get cost of goods sold is equal to 42 lakhs. Rate of gross profit to sales is given as 25%. We know gross profit plus cost of goods sold will make the total sales. So the cost of sales is 75% of the sales. Since the cost of sale is 75% of the sales, can be found out by dividing the cost of goods sold by 75%, and the sales we will get just 56 lakhs. So GP is 25% of the sales and it works out to be 14 lakhs. Since we found out the sales, we can proceed with the sales to fixed asset ratio, which is given us 2 times. That is, sales divided by fixed asset is equal to 2. Fixed asset is equal to 56 lakhs divided by 2, that is 28 lakhs. Now we'll move on to the net worth. Net worth is equal to total assets minus current liability. Since it is given that there is no long-term debts, so total assets is equal to fixed asset plus current asset minus current liability. So 28 lakhs plus 16 lakhs minus 8 lakhs will give you 36 lakhs as the net worth. We found the net worth as rupees 36 lakhs, and net worth contains reserve and surplus and capital. The ratio between reserve and surplus and capital is given as 0.25 times. That is, if the reserve and surplus is 0.25, capital is 1. Reserve and surplus plus capital known as proprietary fund. So you have to divide 36 lakhs in the ratio 0.25 is to 1. Capital is equal to 36 lakhs into 1 divided by 1.25, that is 28 lakhs 80,000, and reserve and surplus is the 25% of capital, that is 7 lakh 20,000. Average debt collection period is given as 1.5 months. That means the credit sales will be collected after 1.5 months, or the last 1.5 months sales is due for collection. So we can find out the debtors by finding out what is the sale for last 1.5 months. It is given that all the sales are on credit, so we can say that debtors is equal to credit sale into 1.5 divided by 12. 56 lakhs into 1.5 divided by 12, that is 7 lakhs. So the debtors are 7 lakhs. Now we found out almost everything which we needed for the purpose of the balance sheet. Now we can prepare it in a format. Share capital, reserve and surplus, current liabilities, fixed assets, and current assets we have found out. The total of the current asset is 16 lakhs, and we know stock is 6 lakhs and trade receivables is 7 lakhs. So the balance is cash and cash equivalents. Our balance sheet is got tallied and the total is 44 lakhs. In this type of problems where the format of the balance sheet is not given, our aim is to include as much information as possible. So the maximum details we have to include as per the given problem. Here, even though the current asset includes the prepaid expenses, in the absence of any particular information, we cannot include that one because the cash and cash equivalents we taken as the balancing figure. Now, let us go through the ratios we used in this problem. The first one is the net working capital. The formula is current asset minus current liability, and the second one is the current ratio. Current asset divided by current liability. So as we know, the current assets includes inventories, sundry debtors, cash and bank balances, and prepaid expenses, short-term loans and advances, disposable investments, and any other current assets. But in a problem situation, we cannot take this definition. Normally, the minimum requirement is that there should be stock, debtors, and cash and bank balance. If the prepaid expense is given, that we have to take, otherwise we will confine to these three. And the current liabilities is mainly creditors for purchase and for expenses, and the short-term loans, bank overdraft and cash credit, outstanding expenses, and other provisions. Liquid ratio or quick ratio is defined as quick asset divided by current liabilities. In some texts, it is given as quick asset divided by quick liabilities. First of all, let us check what is a quick asset. Quick asset means that current asset which the next step it will convertible to cash. Cash and bank balance, no doubt it is a quick asset. Then debtors or receivables we can convert it to cash, and other short-term current assets we can convert to cash. When we come to the inventory we cannot convert directly to the cash. First we have to sell it, then it will become debtors, then it will take two steps. So inventory is not a quick asset, it is only a current asset. And the prepaid expenses we cannot convert to cash. The work will be done for the prepaid assets, or we will receive the service and we cannot convert to cash. So inventory and prepaid expenses not quick asset, it is only current asset. All the current liabilities are taken as quick liabilities because of the conservative approach. Because we are expecting losses, we are accounting and on expectation basis, but never we are accounting income or profit on the expectation basis. So on the conservative approach, all the current liabilities we are taking as quick liabilities. The next ratio we dealt in the problem is the stock turnover ratio or inventory turnover ratio. Turnover means sales, and it is a connection between the sales and the ratio given. So the total asset turnover ratio means sales divided by total assets. If the fixed asset turnover ratio means sales divided by fixed asset. Capital turnover ratio means sales divided by capital or net assets. Or current asset turnover ratio means sales divided by current asset. So the name itself is revealing what is the ratio. You have to divide the sales by that figure. But in the case of inventory turnover, there is a small difference. Inventory turnover ratio is defined as cost of goods sold divided by average inventory. If the opening stock and closing stock is given, we can take the average inventory. If only the closing stock is given, we have to take the closing stock itself. And why the cost of goods sold instead of sales? Average inventory is on the purchase basis or the cost basis. So for a matching concept, we have to take the cost of goods sold in the numerator. If we take the sales, it is not the cost, it is we are taking including profit. Cost plus profit we are taking. So for a matching principle, when we are dividing by the average inventory, the cost of goods sold we are taking on the numerator. Sales to fixed asset is given in the problem. It is the fixed asset turnover ratio, which we discussed already. It is sales divided by fixed assets. Reserve and surplus to capital ratio is given. That is the relationship between reserve and surplus and capital is given. But the total of the reserve and surplus plus capital is known as the net worth or the proprietor's capital. Net worth or proprietor's capital can be found out by deducting current liabilities and long-term loans from the total assets. Here in this problem, there is no long-term loans. So by deducting current liability from the total assets, we can find out the net worth. Debtors turnover ratio, as we explained earlier, is finding out by dividing the sales by debtors. It is a turnover ratio. So if the debtors are less, the turnover ratio will be high, and it shows the efficiency of the company in collecting the debtors, and the investment in debtors will be low. If the turnover ratio is low, it means the debtors are high and the efficiency is less. On the other hand, if we know the sales and the turnover ratio, we can find out the debtors by dividing the sales by the turnover ratio. And in this problem, it is given not the turnover ratio, the average debt collection period, and 1.5 months. As I explained during the problem, it is a time taken for collecting the debtors. That means the debtors for the last 1.5 months is due, or the company is collecting the debtors after 1.5 months. So the debtors can be found out by dividing by the total number of months, sales divided by the total number of months into 1.5, or the given debtors collection period. Hope you would understood the formula for the ratios given in the problem and the logic behind them, and the way in which the problem on the ratio analysis is to be solved. Let us do another problem. Success Limited provides you the following information for the year ending March 31st, 2020. Equity share capital rupees 25 lakhs, closing stock rupees 6 lakhs, stock turnover ratio 5 times, gross profit ratio 25%, net profit divided by sales 20%, net profit divided by capital 1 by 4. You are required to prepare trading profit and loss account for the year ending 31st March 2020. We have given some ratios and two figures, equity share capital of 25 lakhs and closing stock of 6 lakhs. So checking these two, we can see that it is easy. We start with the equity share capital because the net profit divided by capital is given. Net profit by capital is given as 1 by 4. So we can substitute capital 25 lakhs. So we will get net profit is equal to 6.25 lakhs. Since we got net profit, we can use the net profit divided by sales ratio to find out the sales. Net profit by sales is given as 20%. So sales is equal to net profit divided by 20%, which is 31 lakhs 25,000. From the sales, we can find out the gross profit because this gross profit is given as 25%. Sales into 25%, 31.25 lakhs into 25% is rupees 7,81,250. Now we have given that a stock turnover ratio is equal to 5 times. As in the last problem, we know stock turnover ratio is equal to cost of goods sold divided by average stock. Even though it is a turnover ratio, we are not using sales, but we are using cost of goods sold for the stock turnover ratio. How to find out the cost of goods sold? Cost of goods sold is equal to sales minus gross profit. So average stock is equal to 31,25,000 minus 7,81,250 divided by 5. That is 23,43,750 divided by 5, 4,68,750. Once we receive the closing stock, we can find out the opening stock from the formula. Opening stock plus closing stock divided by 2 is the average stock. By substituting the non-values in the formula, average stock 4,68,750 is equal to opening stock plus 6 lakh closing stock divided by 2. 9,37,500 minus 6 lakh is equal to opening stock, and the opening stock is equal to 3,37,500. Now to complete the trading profit and loss account, we need the purchase. Purchase we can find out from the formula. Opening stock plus purchase is equal to cost of goods sold plus closing stock. Purchase is equal to cost of goods sold plus closing stock minus opening stock. By substituting the figures, rupees 23,43,750 plus 6 lakhs minus 3,37,500 is equal to rupees 26,06,250. That is the value of purchase. From these figures, now we can prepare our trading profit and loss account. We have found out opening stock, purchase and sales. We have already given the closing stock. From these figures, we can prepare the trading profit and loss account. So the gross profit works out to be 7,81,250, and the net profit we found as 6,25,000. So the expense we can take it as the balancing figure, or the difference between 7,81,250 and 6,25,000, that is 1,56,250. That is the balancing figure. So we complete the trading profit and loss account. The two new ratios we studied in this problem are net profit ratio and gross profit ratio, and these are very simple. Net profit ratio is equal to net profit divided by sales, and gross profit ratio is equal to gross profit divided by sales. I don't think it needs much explanation. One important formula we came across during the problem was opening stock plus purchase is equal to cost of goods sold plus closing stock. Cost of goods sold means the purchase price of the goods sold. So value wise, this formula is hold good. Opening stock plus purchase is equal to sales plus closing stock is correct when we take the quantity. When we take the value, we have to replace the sales by cost of goods sold. The ratio analysis is based on the fact that a single accounting figure by itself may not communicate any meaningful information, but when expressed as a relative to some other figure, it may definitely provide some significant information. Ratio analysis is not just comparing different numbers from the balance sheet, income statement, and cash flow statement. It is comparing the number against the previous years, other companies, the industry, or even the economy in general for the purpose of financial analysis. There are a lot of ratios to be discussed. We will do some more problems in the subsequent videos and discuss the ratios through the problems.